now that we have filtered our economic calendar to only show medium and high impact news events for the euro dollar, it's time we apply 2 common strategies that are used when using economic calendars. The first one, very simple and straightforward. We're going to call it turbulence avoidance. Why? High impact news brings a lot of volatility to markets. Meaning that if I have an open trade and I have my entry and exit points, but before it reaches its exit points, there is a upcoming news event, like let's say housing data or CPI. That information right there, even though maybe I missed it or I don't want to trade it, that information is used by speculators in the market to make short-term gains. So we're talking lower time frames, 30 seconds, 1 minute, 5 minutes. If I leave my trade open, there's a very chance that the price of that currency could fluctuate hundreds of points and it could invalidate my trade. It happens all the time. And to avoid that happening, I can just simply avoid trading around major news updates and events. The next strategy we're going to use is fundamental analysis. Economic calendars are a tool for fundamental analysis. Why? Because key information is released, such as CPI, housing data, non-farm payroll, and retail sales, so much more. That leads up to important announcements like the FOMC interest rates policy meetings. And these determine the interest rates for the US dollar, which is the major currency that all the major currencies are vetted against. So if we look at our economic calendar, we've already filtered it, but we see that the FOMC statement is happening next week at 7 p.m. Normally, this is outside of the trading hours, but before this FOMC statement, before they announce the interest rate that they're going to do, there's already a prediction of 5.5%. If we check the details, we see that the actual and forecast has been matching pretty much these past few months. So it's a pretty accurate forecast. However, surprises do happen. And what could change the forecast for this federal fund rate is retail sales that we will be seeing today. Housing starts, we will be seeing tomorrow. Unemployment claims, they could be seen on Thursday. Normally, because of the frequency of the collection of this data, it's pretty accurate. But surprises can happen. And knowing that, okay, the retail sales beat expectations, the housing starts beat expectations, the unemployment claims beat expectations, you could expect the FOMC, the Feds, to continue with their interest rate policy, or on the very slight chance, they might pause. However, it's a very low chance. So that's how you use the economic calendar to use in your fundamental analysis, taking note of the actual and the forecast. And then when the forecast now happens, when the actual data is actually released, look at how the market reacts. Is the market reaction positive or negative? Is it what every other investor in the market was expecting? These things will help you to build your trading bias and make your decision on whether the currency is going to go up or down. You can also use economic calendars to validate your technical analysis. By the way, because you have your technical setup, and if your signals are aligning with any key economic data that's releasing, you can know whether to stay in or to stay out. Now that I've walked you through how to use economic calendars, I expect you to use the tool on your own. And I hope that you'll be able to find a good tool for you that gives you all of these features and that can really aid you in your fundamental analysis before you take your next trade. So, see you in the next video. Thank you for watching.